Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. And today I'm very pleased to be here because I'm talking to Christian Pittard. Now, he's the head of closed-end funds at abrdn, and we're going to be talking about investment trusts, the structure, the benefits for investors, the drawbacks, and the opportunities that they present. So, Christian, thanks for joining us today. Now, can you tell me, what exactly does a head of closed-end funds do?
Well, thank you very much for having me on, Annabel. Head of closed-end funds. So I've been at abrdn at I joined in 99, to 25 years, which is a bit frightening. And I worked on investment trust before I joined, previously in the Channel Islands. Then I was sent to the US, sent to the colonies, and now back in the UK from 2008. And really our job, or my job, is to oversee the team. We have a dedicated team in the UK of 20 people that work full-time on the investment trust business, the UK investment trust business. And we have dedicated marketing, sales, secondary market sales, client relationship, and company secretarial and administration. So there's a team there that we oversee, and we spend a lot of time talking with shareholders and talking with boards to ensure that we're aware of what they would like to see in the future, and how the companies are positioned, and being responsive to client needs.
Excellent. So between us, we've got over 50 years of experience in our current roles, because I've been at the IOC coming up for 26.5 years, and you've been there 25 years. So obviously we've both been involved in investment trusts for a very long time. I'm interested in, why are they important for abrdn as a management group? So
investment trusts are the very heritage of abrdn. Right at the start, abrdn Asset Management was a closed-end fund, and it got open-ended. So we have activist experience right at the very start of the business, and it's something that we've taken great pride and attention with, and we're now delighted to say over 20 years we're now the third largest in the world. So we're the largest investment trust manager in Europe and the UK, and we're third only behind the very large American houses. So we have currently have 35 investment trusts across the group, and we have 17 in the UK, including the Tritax funds, which are part of the group as well. So it's a really important part of the group, and something that we get a great deal of focus on. And I'm pleased to say, in the 25 years I've been here, I've never had as much support backing from the board and the executive leadership team within abrdn to continue to support the franchise, adequately resource it, and look forward to continuing to grow it.
Right. Would you say it's your heritage? I mean, I remember Martin Gilbert, passionate man about investment trusts, again, telling me about when, how they founded and how investment trust was at the heart of the business. So that really comes across. So how about for investors now? What are the general benefits of investment trusts?
Yeah, I mean, absolutely true. I think it's a really exciting time for investors to be looking at investment trusts. As we say, we've both been involved for many years, and there are these moments in time where you look back after the noughties, the tech bubble bursting, the noughties, and we went through, we see discounts after the global financial crisis. Investment trusts can perform very well in a recovery, in an economic recovery, where you see a turn in sentiment, and especially when you start to see rates fall, which is anticipated later this year. So I think income, firstly, is a very attractive characteristic because of the discount. And as we said, excluding 3i, average discounts across the sector at 14%. And there's some really attractive, by historic standards, some really attractive discount levels, which means correspondingly some very attractive yields on these products. So in anticipation of rates coming down, we're hoping that we're going to see further contraction. I think we have seen in UK equity income, we've seen discounts come down already in the last month. And we're hoping to see a continuation of that, and see other sectors start to narrow. And of course, because many of the trusts are leveraged and they have gearing in place, you not only get the opportunity to see the discount contract and the asset value perform, but you're levered into that trend. So you can see some very attractive returns at the right time in the cycle by investing in the sector. And that's hopefully what we can deliver for retail shareholders during the course of 24.
That makes a lot of sense to me, Christian. I have to say, we at the AIC, we did some research recently, and we looked at the returns 5 years after buying investment trusts at 10% or more discount. And I can tell you that we looked through the historical periods over this, and that at that level, the 5-year returns were 89% on average. And then we looked at the returns where you were buying at less than 5% discount.
Yes.
And they were still pretty good, 56%. But clearly that discount and the narrowing of the discount when, things turn up and the recovery kicks in is a big boost to performance.
It speaks volumes. To me, it speaks volumes that the principal buyers in our sector in the last year have been US institutional investors. So professional investors who can invest anywhere in the world, finding real value in UK investment trusts right now. And they're the ones putting billions to work in the sector. I have to believe that these professional investors have thought about that carefully, and these are smart guys with proven track records. They're not doing it for any reason other than they think it's very exciting. So I think the smart money is already recognizing the opportunity, and that's not domestic investors; these are global investors. So I think we'll have an exciting 24. Apologies. As we see these investors, and they're also the ones that are driving corporate action and change, which is delivering for shareholders. So they're aligned with retail shareholders and all the other shareholders. They're interested in delivering returns for investors, and they're not going to be too patient. So I think it's a trend that should deliver exciting returns for retail investors.
Absolutely. Well, it's great to see these activist US investors seeing the opportunity. And to be fair, discounts are beginning to narrow, so those investments are beginning to pay off for them. I actually spoke to one of them when he was over in February, Boris Weinstein at Saba, and he said to me how good he thought the corporate governance of UK investment trust was, and that he was seeing a lot that he liked when he was here. So clearly this sets up opportunities for retail and other investors and financial advisors, wealth managers, lots of opportunities there. Going back to the benefits, we talked a little bit about the income advantage. I know that you have at Aberdeen an investment trust that's a dividend hero. That means it's got over 20 years of income rises each and every year. Can you just explain a little bit more about why investment trusts are just so good for income investing?
Yeah, I think it's been a long-standing tradition, as you say. We've got trusts that have multi-decade track records of increasing their dividends, and we've got funds that are over 100 years old. We've got 150-year-old Dunedin Income and Growth, and Murray Income's over 100 years old. So these investment vehicles have been around for a long, long time, have very established track records, and have particular focus and attention on generating attractive and growing yields for investors. So I think it's a long-standing tradition, and it's something that investment trusts can do because of the permanent capital nature of them. They can deliver those yields and hopefully improve returns that it's hard in an open-ended fund or an ETF form to offer the same strategy, and it's particularly suited to income and growing income. So I think the wrapper lends itself to those characteristics, and that's why you're well served as an investor to look for income from investment trusts.
I mean, I absolutely agree. The investment trust structure allows you and managers to retain up to 15% of their income. They keep that in the revenue reserve each year. then when times get tough, and inevitably, you know, we're investors, we know times get tough. So say in the pandemic, when a lot of trusts are cutting their dividend, a lot of companies, a lot of invested companies are cutting their dividends, then they can rely on that reserve to boost their dividends. And this is why we have this incredible track record of dividend increases year on, year out in the investment company industry. My other thing I wanted to talk to you about, talking about the structure, is the structure's suitability for harder to sell, less liquid assets, things like private equity, things like property, even smaller companies, it has an impact. Could we talk a little bit about those benefits?
Yeah, as I said, the structure lends itself, and you rightly noted, to less liquid asset classes and strategies, which you're not able to offer in a daily dealing investment vehicle such as an open-ended fund or an ETF. And as you've alluded to, there's been a great deal of smaller companies, equity smaller companies, but also infrastructure and real asset strategies and private market strategies. And there's been a whole variety over a number of years that have been created, very innovative, differentiated strategies offering all diversified sources of income. And that theme has been developed extensively by the investment trust sector. So I think it lends itself to the structure, and there have been some exciting innovations, and these are strategies that are only available to investors in an investment trust form. You can't access those strategies in any other retail product.
Yeah, so it's a great way to get access to unquoted companies, private equity, or renewable energy infrastructure, so wind farms, solar parks, energy storage, some infrastructure, some really interesting strategies out there. And the investment trust structure is particularly suitable because you have permanent capital. So they can invest in these strategies, they can take a long-term view, they do not have to worry, as you would in an open-ended fund, about redemptions. They can just take a long-term view, and it's perfect for that type of investment. My other question, especially at the moment, people, I think, ESG, the governance part of ESG, I think, is particularly important for people, and their ability to have a say in how their companies are run. And obviously, investment trusts are companies. I wonder if you'd like to explain a little bit more about that.
Yeah, I think it's a very well-made point. So investment companies have AGMs, which all investors are welcome to attend, either virtually or in person, have the opportunity to quiz the board and the managers directly on strategy and the performance over the previous year. So there's real transparency and accountability by the board, something that they pride themselves on. And we get correspondence the whole time from investors asking questions about how funds position and gaining information, further information. There's a great deal of transparency. If you look at an annual report for an investment company, there's an enormous amount of information that's available to investors to educate themselves and understand how these companies are being positioned. And as you say, you get a right to vote. Every shareholder has a right to vote, and on key strategic matters, many of the more recent investment trusts have a continuation vote, regular, so there'd be a 3 or a 5 year continuation vote, and they offer an opportunity for investors to express their desire to continue with the strategy or not. And if investors don't support continuation, then the board likely to have to look at means to liquidate the fund and realise those assets. So there's real responsiveness from the governance structure that's set up. So having these independent boards that are accountable directly to investors is something that has been a great long-standing tradition, and that's your point about US institutional investors. They hold the UK in very high regard, because by international standards, we're very responsive to investors here relative to other markets. And that's something that is recognised. And perhaps we take it for granted because it's our home market. But actually, by international standards, we're right at the sharp end of good governance.
Right. So I'm just interested. So this board of directors, obviously that seems like a real advantage if you're a shareholder. They're there looking after you, working on your behalf. I'm wondering how you as a manager work effectively with boards, because I don't know, perhaps sometimes you disagree. How does that work?
Absolutely. It's a requirement that the boards are independent of the manager. So no board director can be on more than one fund that's managed by a manager. So they are wholly independent, and they absolutely do. I can confirm firsthand that they hold us to account and are representing shareholders, not representing the manager. And they do, and there's a long established track record, they do change managers that aren't performing, and they drive down costs in the interest of shareholders. They're absolutely clear on that. So we are there to serve the company. As managers, we serve the company and the board, and we're responsive to their requirements. Now, the boards take their responsibility seriously, and they actively reach out and talk to shareholders and ensure that they're informed on shareholder views, and they hold the manager to account. So we have to perform, or we don't get maintained as manager, right? We're at
absolutely. So you have to perform with them, and as I said, they're very independent. So if they want to, they could take a trust away or merge it or any sort of thing.
And a great deal of that's happening right now, of course, because
we must talk about, there's a lot of consolidation obviously going on in the industry. We've seen 5 mergers, I think, gone through already this year, 2 trusts merging together, 5 instances of that. We've seen bids, people making offers for assets. We've seen managed wind downs where, the board has decided on consultation with the shareholders that perhaps, it's best in their best interest if that company is wound up and those assets are sold off and the money is returned. I'm interested, are these changes coming from boards? Are they proactive from boards? Are they positive for shareholders?
Yeah, I think almost universally positive for shareholders. I'm struggling to think of an instance that isn't. And they're driven by shareholders talking with boards, and boards recognizing their obligations to those investors, and they've got to narrow those discounts. And one of the ways of doing that is returning all the capital to shareholders and liquidating the fund, which we've seen examples, but also consolidation and partial return of capital to shareholders, but consolidating into a larger, more liquid, lower cost vehicles. And that, as you say, is an increasing trend, and there's more of it than ever. So I think boards and investors are recognizing there is a solution to these wide discounts, and they're actively working on it. So people are not sat idly waiting just for rates to come in this year. That's not the business model of these US institutional investors. They're driving change, and the boards are recognizing it. And even the ones that don't have the US institutional investors on the register recognize the changes that have taken place in the industry, and they're being responsive to it. So even the funds that haven't yet announced, there's plenty of conversations going on that aren't public, that are still driving. They're looking to drive shareholder returns. And
watch this space. In that case, watch this space. More potential opportunities for investors. Now, I am conscious that all of this so far has sounded rather positive. And obviously, the investment trust sector has got strong returns. Over 1 year, it's up 16%. Over 5 years, 49%. Over 10 years, 172%. That is obviously the sector average. Of course, that will be variation between sectors and companies. But I have to ask you, what are the potential drawbacks for investors of investment trusts?
Well, clearly gearing, for instance, works both ways, right? And if we do have geopolitical risks manifest themselves, and people feel equities in general or other asset classes, they're not as optimistic about the future as they are now, then the gearing will accentuate those softening of market prices. There's no doubt about it.
I mean, I have to jump in there because I always like to think about gearing as it magnifies performance. So it magnifies both ways. Okay, so if we're going to have strong performance, then you're going to get a boost with the gearing. But if we're going to have poor performance, then you're going to have a drag in your performance from the gearing. Having said that, I think it's important to recognise that the average gearing in the sector for trust is only 9%. And
Yes.
actually, around 50% of investment trusts do not gear at all. So what you need to just be aware of is you need to look at your potential investment trust or the sector and compare it with the sector average. Because not surprisingly, sectors like property, we've all got mortgages in a way. That's a way of gearing, isn't it? We've borrowed to buy a house. That's going to be the most geared, the property type sectors. But a lot of sectors have got much lower levels of gearing. As I said, the average is 9% and around 50% don't gear. So it's just something to take a look at when you're doing.
And they've tended to reduce gearing, right, because of the higher borrowing costs in the last 18 months. Many trusts have reduced their gearing. So there's less gearing in the structures now than there was 2 years ago.
That's true. Although interestingly, some of the UK trusts have been increasing their levels of gearing. And I think that is obviously reflects confidence in the opportunities in the UK market. They're really thinking this is the time. We need to be borrowing. We need to be then investing with that money. Whole idea of the gearing is that we're going to make a better return on our investments, even with the cost of gearing,
Yes.
because of that borrowing. And that's what they're sort of telling you. They've got some optimism. Now, of course, none of us know what's going to happen with markets. None of us know. But I have to say they have had a pretty good run so far.
Yeah, that's conviction. I think borrowing costs, base rates at 5.25%, you're borrowing 6 and a bit. You have to believe that, as you say, your return's going to exceed the cost of your borrowing. So the threshold at 6, that's real conviction. I think it's exciting that optimism is starting to return and people feel sufficiently confident that they're willing to allocate in that fashion.
Absolutely. And I think the other thing that generally, advisors and wealth managers get concerned about is discount volatility. But, we have to say that, the discounts are relatively wide at the moment, around 14%, excluding 3i. I mean, the reality is if you buy at a certain discount and sell at a certain discount, and it's the same, it doesn't actually make any difference to your investment, quite honestly. But if you're buying when discounts are relatively wide, the idea behind that is that you're hoping that you get a recovery in markets, discounts narrow, so then you've got an additional boost to your performance. So you could have you could have a triple whammy if you were really lucky. You could have share prices recovering, then you've got discounts narrowing, and you've also got gearing kicking in. Of course, that's an ideal scenario, and nobody knows where we're going. But we have seen discounts narrow from the levels that we were at before.
But to the point you just made, I think why the sector's less well covered than it should be is because it requires some additional understanding and thought, right? And a lot of investors aren't necessarily willing to understand those variables. I think it's very exciting. It can work in your favor, but it requires some thought and additional work over and above a more straightforward. But I think that's commensurate with the returns, and that's why the institutions are seeing the opportunity. That's why we're excited about it. But the discount volatility, people get very focused on that, and I think short term it can move, but as you say, often long term it doesn't drive your performance. But what it does do is lock in those attractive yield rates for you. So I think people can get very focused on that, but often long term it doesn't impact your performance that significantly, but it is an attractive entry point for a yield level that look like, by historic standards, they look attractive.
Absolutely. And I always say, I mean, the investment process, a lot of it is very similar, but with investment, similar as an open-ended fund. But with investment trust, you've got to think about gearing, and you've got to look at that, see what the gearing level is. You've got to look at the discount and compare it to the sector average and the industry average and see what's going on with that. And you potentially, if you're making a very big investment, you need to look at the underlying liquidity of that company if you're making a really big investment. For most financial advisors, that wouldn't be an issue, but if you're a big wealth manager, perhaps that would be an issue. And those are the three additional things to consider. But generally, the rest of your investment process is very similar to an open-ended fund.
Yeah.
So, I mean, looking at this, what's the outlook for the investment trust industry? What do you think? You sound like you're pretty positive, Christian.
I have to be, it's my job. No, I think it is an exciting time. I think it's been a torrid 2 years while rates have increased, discounts have widened, but there is real change happening, being driven by shareholders, being driven by boards. We're seeing consolidation, we're seeing managed wind downs. People are responding to the current environment, but in the expectation that rates start to come down, those actions are happening, the shareholder-friendly actions are being implemented. You're seeing increased appetite for UK equities and other asset classes. Doesn't look like we're going to get the hard landing that was feared a year ago. I think the sector's well positioned. There's no new issuance of paper, no IPOs have been undertaken, no one's doing any meaningful secondary offerings. So the amount of supply of investment trust paper is contracting, which certainly helps with pricing. So hopefully in 12 months' time we'll be in a significantly better place, and people will have enjoyed some attractive returns in the intervening 12 months. And then they can look to new strategies and new ideas, and we could come up with some new funds. But that's 12 months from now, not 3 or 6.
Yeah, I have to say, I think it's a time where there is a huge amount of opportunity available. If you look at the historical trends with discounts, you know, at some stage they come in, and when that recovery comes, they come in, and that is a boost to your performance. But, you know, for long-term investors, you know, the structure is particularly well suited for long-term investing because of that permanent capital, because of the benefits when it comes to income. There are lots of reasons why investment companies produce strong returns for investors.
And there's no other structure that can offer you those strategies. Even there are some new developments, LTAFs and other structures and ETFs, but no other structure has the permanent capital nature that allows you to invest, to offer those strategies, to invest for the really long term. That's unique to investment trusts, remains unique to investment trusts. So I think they've still got an exciting place in investors' portfolio.
Well, we have been around since 1868, and I think we're going to be around a lot longer. If you think about the things that we've survived, you know, 2 world wars, you know, the Great Depression, clearly more recently, the tech boom and bust, the pandemic, I think we've got a very strong and long future ahead of us. My last question. What do you enjoy most about your job? What gets you out of bed in the morning?
Well, this is clearly a highlight of 25 years. This is a culmination of 25 years in the industry. I've achieved everything I set out to. No, I think it's there's real pride in turning an investment idea and a concept into a company and then watching that evolve. Because as you say, because they're around for so many years, if you come up with an idea and it's launched, these are perpetual vehicles. They will outlive my career and, you know, my children's career potentially. So it's very satisfying to see a product develop and evolve. And the example, I wasn't involved in the launch, but the example which is in our stable is Tritax Big Box. So it was launched in 2013. The merger hopefully closes with UKCM on Thursday of this week, 16th. It's due to be finalised, and that will put it within a shot of the FTSE 100. So to go from scratch to a FTSE 100 company in just over a decade is a remarkable achievement. But it clearly you've got to have it in the right category in the development and evolution of online retailing and logistics. The need for logistics real estate has transformed in the last 10 years. So it's been part of that trend. But that's enormous sense of pride and satisfaction to see something like that develop and continue beyond my career and for many years to come, I hope.
I can really understand that. Let's hope we see this merger go through. Tritex Property, UK Commercial Property, very big company, very liquid company, investing in warehousing and logistics. And let's face it, I live in the countryside and I'm very reliant on all those services to bring me my products and things here. So I don't think it's a trend that's going away anywhere soon.
So the great, obviously where the structure works best is with real scale, and then there's very deep liquidity and reduced expenses. So there'll be, if big box goes into the FTSE 100, there'll be 5 UK investment trusts that are then FTSE 100 companies, which I'm sure is a record. And if you look back in time, they've only increased in size and structure. So it's great to see more and more entrants in the FTSE 250 and the FTSE 100 from investment trusts.
Absolutely. Bigger trusts, larger, more liquid, more cost effective, and hopefully better performing.
Yes.
Christian, thank you so much for talking to me. Thanks also for watching today. We're going to bring you more interviews and more panel interviews on investment trusts in the future. Thanks very much.
Thanks.